A stock, as discussed in the previous video, represents a part of a company that anyone can own. They are by far the biggest tool people have in order to create, keep, and maintain wealth. In the previous video, we discussed what a stock is. In this video, we'll go over how to set a foundation for good investing habits, learn some basic vocabulary, and why you should invest in the stock market. First of all, why invest? I'm not sure if I consider investing for everyone or not. On one hand, there is a lot of sacrifice and hard work that goes into investing, where if people don't want to do it, I completely understand. But on the other hand, investing is by far the most powerful way for people to build wealth to a point where you're handicapping yourself and your future by not investing. However, if you're watching this channel, then you likely fall into the latter. But in the case that you are not, and you in fact are new to the world of investing, I highly recommend investing. Income from investments fall under what we call passive income, which is the opposite of active income, which just means instead of working a regular job for income like many people do, you have your money work for you. This simple concept is what makes investing valuable because it gives you more of one thing you can't ever get back: time. You probably don't want to spend all your time working, so investing presents an opportunity for you to make money without having to work. Another reason investing is recommended is because of the tax advantage it gives you. You can classify the people who help a company grow into three groups: workers, thinkers, and owners. Workers are the employees, from the sales associates to the engineers to the marketing team, etc. Thinkers are the C-level executives who do all the thinking and direction of the company. And then you have the owners, that are the people who own the company. Let's take a look at Kraft Heinz to understand how much taxes each of these guys are paying at a basic level without using any tax loopholes. Workers at Kraft can make anywhere between $32,000 to $400,000 a year. The chairman of Kraft during the year of 2023 made about $43 million. And the largest owner of Kraft, Berkshire Hathaway, made $521 million. As you can see, the owners by far made the most amount of money from Kraft, which may not surprise you, but what may surprise you is how much of their income is taxed. The workers can be taxed anywhere from 10 to 35%. The CEOs and leaders can be taxed anywhere from 39 to 52%. Based on this information, how much taxes do you think Berkshire Hathaway is going to pay from their income received from Kraft? 20%. Despite making 10,000 times more than the average employee, they only pay 20% of their income as taxes. The way the US system organizes its tax code, it allows owners to pay less taxes than the common worker. And this isn't really a tax loophole in the traditional sense. This is actually really straightforward. When you work a typical job, you pay taxes on what is called earned income. Earned income is taxed at the typical tax rate that many of you are probably familiar with. It probably looks something like this, where if you can make the average income of anywhere between $40,000 to $80,000, you can be paying anywhere between 12 to 22% of your income as taxes. However, income made from stocks held over a year is not taxed as ordinary income, but as long-term capital gains. The taxes from long-term capital gains look something like this, where if you are filing single and make $40,000 a year, you would have to pay $0 in taxes. And if you're filing jointly, you can make up to $80,000 and pay $0 in taxes. The fact of the matter is, stocks are taxed more favorably, making investing in stocks advantageous to anyone. Another foundational key I wanted to take away from this video is the difference between trading and investing. Trading is short-term, usually considered less than a year, while investing is long-term, which is usually considered more than a year. This is important because, as discussed, long-term capital gains is taxed more favorably, emphasis on the long term. Short-term is taxed similar to earned income, as you can see. When people buy and sell shares within the same day, this is known as day trading. This is as short-term as it can get. Stocks can have massive swings in a day, and if you pick the right stocks, then it is absolutely possible for you to make more money than the long-term investor. But the problem is, humans aren't very good at picking the right stocks, which means over the long term, the investor generally does better than the trader. The stock market on average returns 10% a year, but any given day, there will be stocks that can go up to 10%, go down 10%, go up 50%, go down 50%. If you do find the right stocks, you can, let's say, make 10% a day, which not even compounded can make you 3,650% a year. But as mentioned before, humans, even the experts, are not that good at picking stocks. It is estimated that 89% of experts fail to beat the stock market's 10% a year return. Sustainable wealth is built long term. When investing, it is always important to remember that Rome wasn't built in a day. When trading, it is important to remember that Hiroshima was destroyed in a day. With that being said, in this channel I will cover both trading and investing in detail in the future, so make sure you like, comment, subscribe, and hit the notification bell to stay updated when those videos drop.